Rule 49. Build a bit of capital, then invest it wisely. Lots of people don't get prosperous because, as we saw earlier, they are too lazy. But a lot fail because they don't know what to do after they start to earn some money. It's easy to think, once you've got your hands on a bit, that you have earned it, you deserve it, you're going to spend it. You have earned it, assuming you haven't robbed anyone to get it, and yes, you probably do deserve it. But no, don't spend it all now, no matter how much you want that new car, vacation, cottage by the sea, whatever. I've done it. I guess we all have. I once got a massive tax rabbit. I don't remember why I was being taxed so highly, but I was for several years, and when they repaid me it was quite a handsome sum. And of course I blew it, on a fantastic vacation. But that's the difference between the rich and the not so well off. The rich see a sudden windfall like that as an opportunity to make some more money out of it. The not so well off remain not so well off as they see it as an opportunity to have some fun. Nothing wrong with that, if that's what you want in life. Instantly sure. But if you want greater wealth and pleasure, albeit delayed, then you must learn as I did, that once you get your hands on a lump sum, or build some up, you must immediately put it to good use. And frankly, the only good use is as a starter kit for prosperity. And it isn't lost, merely put to one side to work for you. When it has grown and attracted lots more lovely money, you can have all the vacations you want. But you have to wait, and you have to use that starter kit well and wisely. See it as a loader. This is a term guides who receive tips use for starting the tip collection off. You have to put a loader in the plate, or no one else will tip. Buskers do the same thing, put a coin or two into. 102. The rules of money. The hat to get the crowd going. No one will put anything into an empty hat. What you are going to do is load your prosperity hat. Ah, but I hear you say, I'm never going to get my hands on a lump sum. Not true. You get your hands on a lump sum every week of your life in the form of wages. I'm assuming you do have a job here. You choose what you spend that money on: mortgage, food, car, entertainment, and so on. But if you want a way out of that particular lifestyle and into another, you have to be proactive about it. And the way you start it is to put something aside each week to build up that lump sum. When you have something built up, think about where that money is going to generate you more money, and get it invested. Ideally, you need to turn that money into an asset that will generate more revenue for you, be it shares, a property you can rent out, or something else. Wealth happens slowly over a period of time when you turn surplus cash into something that will work for you. No one will put anything into an empty hat. Rule 50. Understand that property, in the long run, will not outpace stocks. So you've built up a bit of money to invest. Where to put it? Property and stocks are two popular choices, but which to choose? In the aftermath of the dot-com crash of 2000, when stock prices started to plummet, many people turned from investing in stocks to investing in property. It's not surprising, really. Many people who invested heavily in stocks in the late 1990s saw the value of many of those stocks drop so much it really hurt, and some companies folded completely, meaning investors lost all their money. With people turning in huge numbers from stocks to property, the buy-to-lease market boomed, and with greater demand from investor buyers, house prices rose. Eventually we reached a point where in some areas there was a glut of property available to rent, and income from rental properties failed to match expectations, supply outstripping demand. However, those early into the buy-to-lease boom who bought in the right areas did well. In the years since 2000, however, stock prices have recovered, and those who could hold on to their stocks on the whole have seen their value climb again. So what's the right thing to do? Property or stocks? Well, shorter-term blips notwithstanding, in the longer run, stocks will outperform property. Don't get me wrong, there's always a place for property. It's about getting yourself a good spread of investments, a portfolio as the professionals like to call it. Any decent investment portfolio is going to include property as a matter of course. One big advantage of investing in property is that you can live in it. As we said in Rule 47, you have to live somewhere, and you can't live in cocoa futures. Alternatively, if you're buying to lease, you will get income from the rental of the property. Though you have to be extremely careful that the rent is as much as you hope it will be, that you are sure there is enough demand for rental properties in that area, and so on. With stocks, you hope to get regular income in the form of dividends paid to shareholders, but the greatest return usually comes from a long-term increase in share prices. And quite simply, as companies have greater potential for growth than property, the longer-term picture should see shares giving you a greater return. I stress potential here, as it doesn't always get realized. The value of your stocks or your property can go down as well as up. There's always risk. The other reason to prefer stocks to property alone is that stocks, especially a nice well-balanced portfolio, will give you a decent risk spread. The more variety, the less the risk. Did you know that in a slump, baked bean sales go up? Any decent investment portfolio is going to include property as a matter of course.